And to start with, as we all know, the development on the property market is very well connected with the overall economic development. And looking at the Nordic region, it really stands out in a European perspective when looking at the 4 different countries, both positively and negatively, I would say. This graph shows an index development from 2007 and up until today. And the dotted line in the middle is the kind of average for the euro area. And here we can see that there are 2 teams of Nordic countries. Sweden and Norway have really overperformed, while Finland and Denmark actually has underperformed. And so it's a very split development in the Nordic region, and each country is really in different position in the economical cycle. What we can see here basically is when looking at Sweden and Norway, they followed each other quite tightly up until 2014, and after that, I mean, Norway is a really oil and gas dependent economy, very dependent on investments within these sectors, and the lower oil prices, of course, have a hampering effect on the Norwegian economy. So it has been a more slow development, while we really had soaring growth in Sweden during that period. And it really took off from the Nordic development. Looking then at Denmark, this country had a severe housing bubble after the financial crisis, and took rather several years to actually recover from that. We start to see recovery now, and the economic growth is starting to perform in line basically with the euro area average. We see that private consumption is back, and housing prices has started to increase again, while Finland has had a decade basically with very tough challenges in the economy. And here we see basically first now that leading indicators are starting to show a real recovery. I mean, they had a tough development with sanctions against Russia. We've had development with Nokia, tech sector, shipping building sector, forestry sector, and also 2 high wage increases, so they've lost competitiveness during the years before the financial crisis, basically. But now we see signs of recovery from very low levels. But looking at GDP growth figures, we see basically that Sweden really stands out over a 15-year period, over the entire 2000s, basically. And looking ahead, we also see relatively strong growth. I mean, growth will slow down in Sweden, but it will still outperform the euro area, as we see. Average around 2% of the coming 5 years, and rather strong growth. Also looking at the transaction markets and transaction volumes in the Nordic countries, we see a little bit of a split development here. When it comes to Sweden, has really had soaring transaction volumes during recent years, and we ended up at absolute record levels. This is RCA data to have comparables between the Nordic countries, but actually looking at our data, we are up here somewhere. So we really had all-time high figures for 2016 when it comes to transaction volume. In Norway, we've really seen a slowdown on volume-wise, while both Finland and Denmark really have picked up lately. This is rolling 12 months volumes for the entire transaction markets in these countries. And also what's interesting is when looking what type of investors that actually do the deals. Both when it comes to Sweden and Norway, it's a very domestic market. Cross-border investments is the lower, darker field here on the graphs. In Sweden, it's quite expensive. Foreign investors have a tough time basically competing for assets, and the market is very dominated by institutions and listed property companies basically. Also, private property companies in Sweden are big investors. In Norway, we've seen that volumes have declined significantly, and of course also foreign investments, which were quite high actually during 2015, has really come down. While we see both in Denmark and Finland a really upsurge in foreign investments. And in Finland, it's starting to look quite attractively priced compared to Sweden. And we will go in a little bit in what type of investors we actually see in these countries. While Denmark also, I mean, here we see a strong recovery, and over the last years, for instance, we've seen that the residential market have seen quite well priced in Denmark compared to Sweden, for instance. Basically, what we see here, what type of investors is that both in Denmark and Finland, it is actually Swedish investors that kind of dominate the market. That's the biggest foreign investors actually at the moment. So basically what we see is Swedish investors that are driving the Swedish market, make it soar to historically high levels, and they also stands for an important part of the pickup in Denmark and Finland. And we can see that looking at these slides when we look at the top investors in Denmark and Finland over the last 24 months. And here we can see that red bars are Swedish investors, and I mean we have a number of the bigger Swedish investors that are on the absolute top positions in these countries, looking for investments, and have done a number of deals within residential, within public, and also commercial properties. So it seems like the Nordic property market are actually a little bit spread out, different positions on the economic cycle. We see that Sweden are really on the top of the economic cycles. We see Finland are on the absolute bottom and starting to come up, starting to see signs of kind of recovery. And we see that Denmark is somewhere in between, and Norway are kind of following their own pattern based on oil and gas prices, basically. A very commodity-driven economy. Well, then focusing on Sweden, we see basically now that prime yields are actually starting to bottom out. What's interesting here is actually looking at the London market just as a comparable. I mean, London usually be a good leading indicator for the development, specifically in Stockholm. London is the thin dark line here in the prime yield curve. What we've seen is that yields generally in the Nordic market have come down to historically low levels based on enormously low interest rates, of course, and strong rental growth, but they've bottomed out. But what we see here is that London historically has been around 6 months ahead of, for instance, the Stockholm market. London has now starting to see increasing prime yields. That is, of course, due to the effect of Brexit and so on, which are kind of local factors. But usually, looking over 10 years, London has been a really good leading indicator. But so basically, what we see is at least a bottoming out of prime yields on very low levels in basically all Nordic markets. What we see also is that spreads differ a little bit between these markets. We see that spreads between prime and secondary properties are very tight, basically in Sweden, in Norway, and actually in Denmark too. In Finland, however, we see very large spreads. Here we see we are absolute on the bottom of the economic cycle, and there are very high yields to be found, just move a little bit outside the absolute prime end of the market. What's interesting also is looking at the rental market. And here actually we see a leveling out of prime office rents in all Nordic capitals except for Stockholm. Stockholm really stands out with this development. Just a surge during the last year. Actually, this is also to have comparable between all Nordic countries is PMA data, and actually the real level is even up here compared to the levels we actually see on the market. The market rent levels, which is around 6,400 SEK per square meter, which is around 650 euros per square meter. So we've really seen soaring rent levels in Sweden. So that's really an outlier comparing to the other markets. And of course, that is due to the recent years' very strong economic growth. And I will also come into the structure of the growth, what has actually created this very strong rental growth. But it's reasonable to assume as kind of a stabilization here on Swedish rents, because growth rates over the last 6-7 years have actually been around 7% on an annual basis in Stockholm, which is just enormously high growth rates. So we come from a period with a very strong rental growth, and that has also, of course, been a factor driven down yield levels, and because it creates lots of potential in kind of the average property in the prime end of the Stockholm office market. Well, going more into detail on the Swedish economy, we see an economy that actually have hit full capacity utilization now. An interesting way to see this is looking just at the GDP gap, which is an indication of how much spare capacity we have in the economy. And we see that the GDP gap, this is a inverted scale, of course. Then we see that GDP gap is very strongly correlated with quarterly GDP growth. And what we've seen is that basically in early mid 2016, the GDP gap actually closed, which means that there is no more kind of spare capacity in the economy. We are at full capacity utilization, and historically, I mean, it's a strong correlation. When we hit full capacity utilization, we see that growth goes down to the potential growth, which is decided by the growth of the labor force and the productivity growth. And that should be around 1.5–2% in Sweden. That's about where potential actually is. So that's where we're heading towards. We're going, I mean, those growth rates of 3.5% for 2016 are approximately, and 4.5–5% that we saw during 2015 is actually not long-term sustainable. It's more around 1.5–2 that is a reasonable growth rate. So that's where we're heading. And I mean, looking at the stock market, that has also indicated a slowdown in growth for a while. The Swedish equity market, broad index for the equity market, is generally a leading indicator for GDP growth around 9 quarters ahead. And that has been indicated a slowdown for a while now. So we expect slower growth just based on that we have hit full capacity utilization. And that, of course, will impact the property market looking ahead. But it's also interesting to understand what actually is driving the Swedish economy and where is the growth actually takes place. Because, I mean, property is very local by definition, and GDP is kind of a national average that really don't exist. You need to look into regions to understand where actually growth takes place. And what's interesting here is to see at the development over the last 20–30 years. Here, the dark blue line is GDP growth since early 90s. And the light blue line is net exports contribution to the GDP growth. And what's interesting here is the structural shift that actually took place after the financial crisis. Before the financial crisis, after the crisis in early 90s in Sweden and going ahead, we devaluated our currency and we exported ourselves out of the debt problems that we had at that moment. And we saw that net exports contributed around 1 percentage point to growth each year, up until the financial crisis. After that, something took place. Something happened with global trade. We saw that global trade growth, which previously had a stronger growth rate than global GDP, actually started to slow, and that didn't occur anymore. The growth in world trade was more in line with global GDP growth, and that impacted the Swedish net export growth too. And from 2008 and onwards, we actually have seen that net exports have reduced Swedish GDP growth with around 0.5 percentage points per year in average, rather than contributed. And what has actually driven growth during this period is private consumption, now lately public consumption, and investments within the residential sector. That's the major growth factor actually that had driven growth during the recent years. And that also is very concentrated to few spots in Sweden when looking at the map. This is basically a map over population growth, where blue areas shows falling populations and red areas show increasing populations. And that is very strongly correlated with GDP growth. And what we've seen basically is that it is the 3 major cities in Sweden that actually have stood for the absolute majority of GDP growth over the last 15 years. Stockholm has, by itself, the Stockholm region has stood for like 50% of GDP growth over the last 15 years, while Gothenburg and Malmö have represented around 25% of GDP growth, and the rest of the 25% has been basically in regional cities. And the rest of the country basically has no GDP growth at all. And that is not very strange when considering what type of economy we've had. I mean, during the last year globally, financial policy has really been a low priority area, so to say. We have stimulated growth with monetary policy, and that has increased basically since the financial crisis, and that of course creates growth and consumption where we have large asset prices, and we have large asset prices in the major cities. So that is not very strange overall, because the way we have stimulated and the economic policy we've had in Sweden has really propelled growth in the major cities, and has actually hampered growth in the rest of Sweden, because we really haven't had that much of an active financial policy. So historically, consumption has really been a driver, and it has really been concentrated to the major cities, and specifically to the Stockholm region. So that has been really the driver of the economy, and this has been a big impact in how investors have thought and acted on the property market. However, we see now that this growth model is very correlated to the development of the residential prices, the housing prices. And we also see that this is a major risk for growth in Sweden looking ahead. We see that the dark blue line here is the average annual growth rate of Swedish housing prices. And this is a good leading indicator to GDP growth, which is the light blue line. We see that housing prices are around 6 months ahead of GDP growth, and a very, very strong leading indicator, very strong correlation. And we see now that housing prices have held up quite well. New figures came in yesterday, and they show around 8.5% growth on an annual basis. But what we see, and what most forecasters are agree about, is that housing prices growth rate will slow down looking ahead. If not other, just because authorities actually really don't like the growth rate of debt, of housing debt, compared to GDP growth, which has grown. I mean, housing debt have grown faster than GDP growth for like 15 years. And this has been kind of a major growth engine for Sweden. Increasing houses prices have led to increasing debt, which is creating consumption ability in the major cities, and that has been the kind of the driver of the economy. And now they don't like this steadily increasing debts, and want household debt increase to be more in line with GDP growth. So that is kind of the view from the authorities. They have introduced the rules of amortization. They are speaking about creating caps for household debt, and rules to stifle the ability to take on more debt, basically. So this is a factor, because when we do that, and if housing prices actually stabilizes, that will have a great impact on GDP growth in Sweden. Just looking at this combination, housing prices, if residential prices go down to zero, then we're basically back here. If we have the exact same correlation between GDP growth and housing prices as we've had during the last 10 years, that would represent like a GDP growth of zero or something. Probably will not end up really there, but at least slower growth rates and housing prices will really impact GDP growth and push it down and change the kind of the balance on growth. It will be a little bit less concentrated to the bigger cities. And perhaps as we see that, for instance, leading indicators in the industrial sector has been very positive recently. Perhaps we see that the rest of Sweden will actually need to contribute a little bit more, will be able to contribute a little bit more to growth looking ahead, while it will be a little bit less centered to the major cities. What we also see is that the big factor here is the development on the residential sector, and here we actually have seen a structural shift taking place, and we have actually identified that structural shift on the market for rental homes, basically in Sweden, in autumn 2010, September 2010. And what happened then was that the Swedish institutional player Rikshem made a big acquisition in a Swedish regional city, Uppsala. And after that, 8 to 10 institutional and listed companies with national investment strategies have entered the market and really created a entirely new market for residential properties. We can see this in this graph. The lowest dark blue field here is institutions, and the lighter blue field is listed property companies, investments and share of residential, the residential market for rental homes. And what's interesting is that the market kind of shifted at that point. Before September 2010, there were the correlation between transaction volumes and yields was different for residential properties than compared to commercial properties. Actually, we saw when the economy was strong, yields were actually increasing, and while we saw a downturn in the economy, yields were declining. And that is basically because residential was kind of a safe haven. When it was tougher economic times, we saw that investors focused on kind of core residentials, and average yields declined. What we saw since September 2010 is actually that correlation have shifted entirely, gone from very strongly positively correlated to negatively correlated. What we see now is that residential property behave exactly like other commercial properties. And that is a big shift. Now we have the kind of infrastructure on the residential market that really didn't exist before. And that is one major factors why we've seen that yields have come down significantly for residential properties lately. There's a strong institutional and listed company demand for residential properties. And that has been a major factor to why we see that new construction has really picked up lately. And that is one of the biggest trends that we actually have seen during 2016 and also now 2017. This is new construction in Stockholm. And what we've seen is at least a tripling of the supply of new homes, both private homes and condominiums and rental homes, all residentials in Stockholm. And it's a number of factors that have created this surge in supply. To start with, we had this structural shift in September 2010 that really created an investor base for rental homes. Then we've had soaring housing prices. We've had a great political will to actually increase the supply, which has been very low for a very long time. And this is a major factor that will impact the Swedish economy looking ahead. Because what we see now, based on average household sizes and so on, we have a residential demand of around 16,000 to 19,000 units per year. What we see now is that the supply is up somewhere 20,000 to 25,000 units per year for the coming years, looking at current forecasts of the supply coming onto the market. And that is a little bit too high. So there is a factor that not mainly through increasing interest rates, but also due to increasing supply, that we actually see a slowdown in when it comes to residential prices. And that will have a big impact on how the economy works. That will slow down the consumption-driven economy focused on the bigger cities in Stockholm that we've had. And we categorize significant parts of the property market looking ahead. So what we've seen here is that as we saw previously, this is our own figures in SEK basically. We are on all-time high when looking at rolling 12 months volumes on the property market. We got around 180 billion SEK in transaction volume for 2016, and it was roughly the same rolling 12 months in January 2017. So historically high volumes. And what we also see is that most likely volumes will go down looking ahead. I mean, this is perhaps not sustainable volumes looking over time. And specifically, I mean, this is very strongly correlated to GDP growth too. If GDP growth slow down a little bit, volumes will go down too. But what's interesting is that generally over the last 10 years, there's been a very strong correlation between average yields for commercial properties, for the average for retail and office properties, and the volumes for retail and office properties. However, during the autumn 2016, that correlation actually ended and went the opposite direction. We saw that volumes, which is an inverted scale here, really soared, while average yield actually increased. And what increased was mainly yields on weaker performing retail units in smaller cities in Sweden. That's actually where we saw increasing average yields on the market, and that actually drew up the entire average yield for the market. And as we look ahead, probably that is actually the trend that we see, because this is a graph showing GDP growth over the last 10 years. The red line is showing average yields for office and retail transactions, actual deals made. We follow around 80% of all deals made on the Swedish property market and actually analyze them and put yields on them. So we have very good data to actually calculate the correlations and so on with. And then we see GDP growth, and that's in inverted scale, of course. Stronger GDP growth leads to lower yields, and also average 5-year government bond yields. And what we've seen lately is that basically since 2009 here, both yields, GDP growth, and interest rates have been very tightly correlated to each other. They followed each other very well. And what we've seen lately is that stronger GDP growth, lower interest rates have really pushed down average yields. And looking here in Q4 2014, yields really soared downwards and actually declined more than what was motivated by both interest rates and the GDP growth. And that is mainly due to QE, quantitative easings, that started with the Riksbank at that moment. So we really can see the effect of the monetary policy on the average yields on the market here. However, we identified basically during early 2016 that Q4 2016 would be kind of a turning point, because then we will see that long-term interest rates start to increase while we see a slowdown in GDP growth. And that actually took place. And that was due to this weakly performing retail properties basically that pushed up the average yields. And what do we see looking ahead then? Most likely interest rates will keep on increasing. That's the kind of global trend now, which has get stronger basically after Trump won the presidency in the US. And we also see, as we discussed before, a little bit slower growth in Sweden, based on that we are at full capacity utilization, and that we also see slowing housing prices looking ahead. And that will change the composition of the economic growth. And that will push up the average yields a little bit. However, looking at the market, we see a very different behavior on the market, looking at the prime end of the market compared to secondary locations. We see that all players at the moment basically are focusing on the prime end of the market. When it comes to commercial properties, is the bigger cities, good locations, and for retail properties is strongly performing retail centers. And here we see that yields are really on all-time lows. But looking at the more secondary end of the market, yields has increased, specifically mainly for retail properties. But we expect yields to increase also for other commercial properties there. So we see increasing spreads between prime and secondary locations looking ahead. And that is because basically almost all investors on the Swedish property market have seen the development for the last 15 years, where we had a really concentrated growth, where 50% of the growth in Sweden, GDP growth, actually took place in Stockholm. And they have implemented this in their strategy, and they're focusing on growth cities and focusing on good location on growth cities, because that is where you can actually have rental growth over time, while nobody is focusing on the rest. And that is actually creating this increasing spreads. And I mean, looking at assessed yields for different segments, we can really see that yields are very compressed at the moment. Specifically, basically, when you look at yields in Stockholm CBD, for instance, for offices and prime suburb locations, very low yields for the prime suburb locations. But what we see now is that these spreads will most likely increase a little bit. Probably not very much will happen with the Stockholm CBD, because here we have institutions are focusing on these properties. We see that there's a very lack of supply, and everything that comes out to the market, there are lots of buyers on everything. But what we see probably is that it's much less demand when you come out to more secondary locations and smaller cities, and that's why yield spreads will increase looking ahead. And it's basically the same on the retail market. It's just that the retail market is a little bit ahead in this development. We already see this increasing yield spreads. Very low yields for prime retail, while secondary retail has actually already increased, which is also factored due to since Q4 2015, it's harder to get financing basically from banks, and we've seen that margins have increased from banks. So that is also impacting and putting as another factor on underlying increasing interest rates. And what we also see when we look at all the Nordic countries is that there is a very strong correlation between GDP growth and total return on the property market. It's a very tight correlation. So it's basically the overall development is all about how well the economy performs. And because we think that for instance, for Sweden, we will have a continuously rather strong performance in a European perspective. We will not overperform as we've done before enormously, but we will have strong performance. And then we also think, based on that Swedish properties will be an attractive asset class going ahead. And we perhaps think that looking at Finland, for instance, that is where the actual there's a good ability to get good deals just based on their position in the economic cycles. But Sweden and Norway, of course, they will perform well too, based on good underlying growth potential. So to sum up, very different positions on the cycles for the Nordic countries. Sweden are at the absolute top and will probably decline a little bit, while Finland is on the upsurge. We've seen that macro fundamentals really changed during Q4 2016, and that is basically a big factor is increasing interest rates, but also slower growth. Basically, what we've seen during the last 10 years is that you can compare it to tide coming in from the ocean towards shore. All boats are following with the tide. It's quite easy to make property investments and quite forgiving to make mistakes on a property level, because values are always increasing, strong growth and lower interest rates. Now we see the tide is going out. Interest rates are increasing, growth in Sweden is slowing down, and then it's starting to get a little bit more tricky, and it is becoming increasingly important to actually be good at property, be good at investing, and be good at managing properties. That is the winners looking ahead. It will not be that forgiving to make mistakes when you don't have always increasing underlying values. We also see that Nordic property, based on good growth potentials looking ahead. I mean, Sweden may be at full capacity utilization, even perhaps a little bit overheated, but we still have good growth potential looking ahead. So it's very attractive region, and also now when we see that political risks are high and both in Europe and in the US, and lots of conflicts and so on in the rest of the world, then Norden is kind of a haven with very stable development. And we see in Sweden, we see that investors are really focusing on the prime end of the market, all type of investors, and that makes it good opportunities to go just the opposite direction, focusing on secondaries, because there are really no buyers there, and you could during coming years get really good deals done there, because several of the, for instance, the listed property companies, they are interested in cutting off their tail in secondary locations, now are focusing and upgrading the quality in their portfolios. So there are really good opportunities for players that are good at finding assets and also have good models for property management to actually go into those secondary locations. And then it's of course essential to be on the market, to have feet on the ground, to know the market, and of course to use the best advisors when doing those deals.